Welcome back, everyone, to the Exchange Live. My name is Paul Hill, and I'm delighted again to be able to speak to accomplished small cap investor, analyst, and stock picker, Paul Scott of Stockopedia. So, welcome, Paul.
Thanks, Paul, and hello, everyone.
Yeah, well, glad to have you back. We've certainly had a busy period over the last few weeks with news. We've got the assassination attempt on Donald Trump a couple of weeks ago. We've got the withdrawal from the US presidential election by Joe Biden. We also last week had the revealing of Labour Party's growth strategy, the massive IT outage on Friday, and then last night we did have a bit of a bath on NASDAQ with a lot of the sort of overheated AI stocks taking a bit of a beating. But before we sort of run through what all that means for the markets and your view of sort of equities going forward, I don't suppose you could just quickly remind the audience of what kind of stocks you like, what kind of investments you go for.
Sure. Yeah. I mean, my main focus is value and GARP, growth at reasonable price. That's what I write about in my Stockopedia reports each day, where we review trading updates and results statements. But I'm pretty flexible. If I see an opportunity to hopefully make money where risk reward looks to be in my favor, then I'll consider anything, really.
And so how's that gone this year? And I know when we last spoke, you'd had an absolute blockbuster 2023. And how's it sort of like moved forward into 2024?
Well, there are two parts to it, really. I do a sort of a top 20 share ideas that I publish on Stockopedia each year, which is fixed for the whole year. And this is to try and say, well, these are the sort of best of the small cap value reports, really. And that did really, really well last year. It outperformed the market by about 30%. The market was down about 10% in small caps last year at the AIM All Share Index. And this year, we've outperformed the market again by another 30%. AIM's up about 2%. I'm currently up, let me give you the precise figures, 31% year to date against AIM up 1%. So yeah, now Graham Neary, my co-writer, is doing even better than that. He's up nearly 34% year to date. So certainly this year anyway, and last year, the market's been very conducive to our sort of careful value stroke GARP stock picks. You know, we've dodged most of the bullets that you can so easily find in small caps, and we've seen some really nice re-ratings of shares that we've picked this year. We can't guarantee that'll happen every year, of course.
What's the sort of the secret sauce behind that then, Paul? The sort of the magic wand, because if you've consistently beaten it, obviously you're doing something right there.
Yeah, I mean, there's an element of luck, isn't there? You know, you can't.
Don't be too modest.
Well, there is. I mean, you never know precisely what's going to happen, do you, with any company? But I think really just the share ideas we picked this year and last year, myself and Graham, I think really went for three or four key points. One was a nice, sound, safe balance sheet. So we didn't have to worry about dilution or insolvency, which is very important, obviously, in a bear market and tough macro. The second point was just a reasonable valuation. So we didn't overpay for any of the ideas on these share ideas lists. And the third thing was a good, decent current trading update. So we want to buy into things that we'd rather. So we avoided stuff that had warned on profit and just went with things that were actually trading all right in tough macro. And we favored dividends as well. But those were really just the main, very simple points that we went for.
Yeah. Well, I mean, you've certainly done really well out of that. And I know when we chatted back in October, you called the bottom of the small cap market correctly, in fact, and it has rallied since. So what's your view of UK small caps going forward? We've obviously got some pretty rich mega cap tech businesses out in the States, and the UK sort of FTSE 100 has moved ahead as well this year. But there still seems to be a lot of opportunity in small caps. But what's your sort of view anyway?
It's so difficult to say because the market seems split down the middle. You've got a lot of shares which are just constantly drifting down on often quite irrationally. And it's just because of indigestion in the market, I think. I think you've still got problems with sellers who are high and dry, maybe funds facing redemptions, or people who are just bored and want to raise money to put into high growth US stocks. I think that's definitely sucking money out of the market. So we've still got fundamental problems with the whole UK small cap space, but I think it's definitely improving now. You know, you are seeing good quality, decently performing small caps now putting in rises, and the rises are holding. You know, but the stocks where you haven't got any news or where it's just lackluster, you know, they are still subject to drift, aren't they? So we're not out of the woods yet, I would say, but I think we're definitely making progress.
Yeah, I've actually got, let me just put it one chart, because it was something I did share. I did basically, it just shows the valuation for people on small caps.
Oh, okay.
that I did with Mello. Let me just get this size properly. Oh, come on. Where is it? Oh, the button is stopping me sizing it properly. But it basically shows the PE ratios for the sort of like your major indices. So the PEG ratios.
PEG ratios, yes.
And if you show basically the earnings increasing, I mean, AIM is about half of the valuation of NASDAQ there. So, you know, there's plenty of opportunity still, I think, for that.
Yeah, I agree. And of course, we're getting so many takeover approaches, particularly from America. That's telling you the market's cheap, isn't it? Because people are happy to pay a 30% premium and buy it at a price they still find attractive. So it's a bit of a lottery, though. I find it very difficult to predict which companies are likely to attract bids. But you just think, well, if you've got a portfolio of 20, 30 UK small and mid caps, you should get 2 or 3 takeovers a year.
Yeah, no, you're right. If anybody wants to ask Paul any questions, please put them in the chat. But we've had shed loads coming through at the moment, so we'll run through those. But let's start off with something I know you're interested in, just in terms of the oil and gas. We've got a few companies here. We've got Hunting, which is basically a sort of like top level. It does subsea and oil and gas connectors and pipe works, etc. On the marine sector. The shares have done really, really well of late. It's got a huge order book, and I think it sort of specializes in gas and geothermal, etc. It won a big deal, didn't it, with Kuwait oil recently? But what's your sort of your outlook for this business? Because it's still reasonably cheap. It's on about 14 times PE, and it's paid a lot of the debt off.
Yeah, well, what I'm doing with the stock picks today, these are not necessarily my favorite share ideas. What I've done is I've just looked through the last month or two of the small cap value reports that I've written, and I'm just flagging up the best ideas that cropped up, you know. And this one, I wrote about it on the 9th of July, so that's quite recently. It put out an H1 trading update, which was ahead of expectations. And the order book's risen to about $700 million. That was up from $565 million at December 2023. You've already alluded to the fact that it's separately RNS'd several quite big individual deals from Kuwait. I think there were several of those, weren't there? So it's ahead of expectations. The order book's good. It's also guiding for an improved performance in H2 due to cost cutting. Net debt is now negligible at June 24, only about $10 million, which is peanuts for the size of business. Outlook, it says, is positive for both calendar 24 and calendar 25 due to these big Q80 orders. And the cherry on top for me is it has a superb balance sheet. So you're only paying a price to tangible book value of about 1.2 times. So I actually think this is overcapitalized. I think Hunting has surplus capital on the balance sheet that's just in for free. So something might happen, you know, that could attract a bidder, or you could even get, you know, pressure from shareholders for a substantial buyback or a special divvy. So there's layers to this, all of which are positive. I can't find anything bad about it. So I don't know about the long-term prospects for the business. I don't really know anything at all about the business, to be honest. But I'm just looking at the numbers and saying, look, I think this, for all those reasons, this looks good.
Yeah, no, it certainly looks a really high quality group, no doubt about it. It's been around for a long time, and I think it's one of those crown jewels on the UK stock market. And as you're right, as it generates so much cash, what's a real feature actually of the small and mid cap is the amount of buybacks actually on the market at the moment. Like every single RNS in the morning, you get a holding, but you get a big sort of, you know, transaction in own shares, don't you, in a group? And this one, we've got a lot of cash, can do it obviously at a very good price.
Yeah, and I think private equity would you know, they like businesses where there's loads of surplus capital, don't they? Because they can then just gear the thing up and pay for it with bank debt. So yeah, no, interesting on that one.
Another one in the same sector is Gulf Marine Services. And I remember you mentioned this to me at about when they were about 3 years ago, and I think they traded about 4 or 5p.
They did.
They're currently quadrupled that. But the one feature that you talked about has been the sort of magic source of the solid balance sheet. This one has got sort of like 2.5 times net debt to EBITDA, but it is paying it down. Can you just talk through what your latest view of this business and why you thought that obviously now that's not an issue at all?
Sure. Yeah, I took my eye off the ball a bit with Gulf Marine Services. You were right. We were all over this about three odd years ago, but it was very high risk back then. I think net debt to EBITDA was about between 6 and 8 times. So it was almost technically insolvent, really. But the story was that it throws off so much cash from renting out these specialist ships. They look more like oil rigs, but they're actually mobile sort of jack-up, I think they're called. And it owns, I don't know, something like 7 or 8 or 10 or 12, something like that of these things, all bar one in the Middle East. And they are now in very considerable demand. So the daily rate for these things that are hired out at is about $32,000. All these figures are very rough off the top of my head, but the operating costs are only about $12,000 a day. So it makes a whacking great margin. And they're also now being used for servicing and installing and repairing and replacing wind turbines. So they've got a much bigger potential market. Now, all you have to do is look at cash flow, forget the P&L statement, and to a certain extent, forget the balance sheet as well. The cash flows are absolutely prodigious now for Gulf Marine Services, and it's deleveraging at an extreme rate of knots, such that it should be completely debt-free by end of 2026. So all we need is 2 years more of bumper trading, and all the the guidance has been positive and being raised and everything, and then you've got something that's debt-free that you could value on a sector EV to EBITDA ratio of about 5.5, which would make it worth about 2 to 2.5 times the current market cap once the debt's gone. So all you do is, from my point of view, all I've done is I'm going to just buy it and just sit there and do nothing for 2 years. And I should double my money, providing nothing goes wrong, which of course it might do. And and the downside risk on this one, it's not really a downside risk, but the reason the shares have really struggled of late is that the biggest shareholder is now selling. CFOX, I think they're called, and they operate in the same sector. So people are naturally asking, well, CFOX know this company better than any of us, so why the hell are they trying to get out of the shares? And they took a 15% discount. The shares were 20p, and they did a secondary placing at 17p. But to me, that is an opportunity, because I think without that CFOX seller, these shares would be 25 to 30p on fundamentals. And it's not a colossal amount of money. The market cap's not massive on this, so somebody might come. And as we saw with Card Factory recently, the big selling over there from Tele IOS suddenly bang got cleared the other day, and the shares went up 15-20%. So I'm tending to see these selling overhangs more as an opportunity for a patient investor. The other thing is Gulf Marine Services. The dividend paying capacity of this thing is potentially huge from those cash flows once they've got the bank debt down to. Now they've got to refinance the bank debt, but because they've got the EV/EBITDA down to about I can't remember exactly.
I think it's 2.5 times now.
2.5 times, yeah. They're saying that will not be a problem refinancing debt that's so rapidly coming down. So have a look at it. Not entirely without risk. I mean, something could go wrong, but I think the deleveraging is phenomenal when you look at the note from, I think it's from Zeus. There's a note available on Research Tree. So have a look at that, and you'll get the story more easily looking at the forecast cash flows.
Yeah, no, I would agree. And I was just looking at the numbers. I mean, it trades at sort of like 5 times PE. And so you're right, if it was 25p rather than 16, it'd still be only on sort of 7.5 times PE, which is frankly dirt cheap. So yeah, plenty of upside. Got a question coming in from Nashish Ranji, and he basically asks about Plexus. Can you give us your latest thoughts on this one? Because I know you've in the same sector. I know you've held it for a few years, did very well, and I think they've just had a big change at the top, haven't they? the long-term CEO has decided to become the non-exec chairman.
Yes,
Somebody's moved up, and then the CFO's moved.
Yeah, I mean, that was expected because the CEO has been in there about 40 years and he's mid to late 70s. So it was, there were no particular surprises there. Unfortunately, there's not really much I can say about Plexus because we've just not had any news. Obviously, last year it was a phenomenal share. It 15 bagged, I think, from the low to the high, from 2p to 29p. But it's done this thing where you just, over the last 6 months, where there's just basically been no news. I mean, I'm a little bit cross with the company for just having a total blackout of news flow. And of course, people just drift away, don't they? But
just for investors, I think it's basically does this POS grip, doesn't it? It's leak free, helps sort of like drillers sort of make sure they don't get methane and gas leaks and stuff.
Yeah, it's a specialist engineering company with very, very good IP that's been going a long time. And back in, I think it was a growth share on AIM, very similar number of shares in issue to what there were now, and it peaked at £3 a share at 300 million market cap in about 2015. Then all the drilling dried up because of the low oil price and the global macro factors and everyone going on a green agenda, and it basically had a 6-year patch where it made consistent losses each year, but the CEO refinanced it with his own money and with no dilution to other shareholders. And then in last year it won its biggest ever contract and also sold some IP to Schlumberger recently. So there's a potential multi-bagger there, but it's dependent on them winning more contracts. And so far we haven't had any proper news really from it since about February. So but it's got cash, it doesn't have any debt at all. So I'm just going to run with it and see what happens, because
it's still your largest position.
Yeah, it's my biggest position. I bought some more yesterday actually. I think I'm up to 2.97% now of the company because I don't want to go above 3 and have to fiddle around with these RNSs, and everything.
Yeah, I know.
So look, it's to a certain extent it's an educated punt. It's not a complete punt, but I can't give you any more details on the fundamentals because we just haven't had the news, I'm afraid. So sorry about that.
How does the POS grip actually get sold? Does it get sold as a points sort of like product, or is it a sort of like a solution within a sort of oil things services sort of drilling contract? Does it go into one of the big oil and gas guys who then sell it as part of their solution? Is that how it works?
Well, my understanding is it's a very small number of specialist engineering contracts. So each contract typically is quite big, so £1 million plus. And it will be a bespoke engineering solution, particularly for wellheads where it's very high temperature or very high pressure, because the Plexus technology, all patented and reams of IP on it, is guaranteed leak free. And of course, the world is now focusing very much on wellhead methane leaks, which it turns out are something like 10 times worse than the industry had admitted. So they've got this big macro thing moving in their favor. But they struggle to sell it in sufficient size, to transform the company's fortunes. But they won this 5 million contract last year, which was then extended to 8 million, and I believe has potential to be extended further. So you don't need many contracts of that size. You only need a handful, and you've suddenly got a 5 or 10 bagger or more. So that's what interests me. It's that asymmetric risk reward. But I don't know whether it'll work out as the upside case will play out or not. There's an element of guesswork there.
Yeah. Well, I mean, you have to be patient to make the long-term profits, don't you? So
it's got enough cash for the time being, so there's no dilution risk for now. I'm just going to run with it and see what happens.
Yeah, no, good idea. We've had a couple of questions just in a similar sort of area. We've got Mart and we've got Edward Hardy. First, Mart asked about the GB Energy, the new government's plan to set up that sort of like renewable bank to be able to finance what that, to sort of finance offshore wind farms and solar businesses and that. And he asked about how that might impact sort of like existing green energy companies such as Good Energy. And likewise, a similar question as an update from Edward Hardy is on U Group, which is also in that area of sort of challenger energy power suppliers. I think U Group supplies businesses, and I think Good Energy supplies consumers. So it's a sort of like a it competes against the big operators like Serica and these kind of guys, both on the business side and one on the consumer. I don't know if you've got any thoughts on either of those, how competitive it is. I know they've got a large collateral, haven't they, and that kind of stuff.
Yes, I mean, I've looked at. I haven't got anything to add on the GB Energy thing. That's sort of outside my area of expertise. With you, I've always been rather sceptical on this, which annoys people a lot. I have one reader in particular who likes to take me to task for being negative on this share, despite it whilst it's 10 bagged, which he used a little bit of poetic license in that. But actually my reports on you are always balanced. You know, we give the positives, which is that it's traded fantastically well over the last couple of years. But the main negative for me is that all it's doing is reselling utilities. You know, it doesn't. Nobody has explained to me how it's managed to suddenly go from losses or negligible profits pre-energy crisis to making huge profits now. Well, it seems obvious to me. They're riding a wave of the energy crisis that's likely to be competed away as conditions normalize. You know, because the other providers of utilities are not making out like bandits, are they? As far as I'm aware. So no. So I'm skeptical on it, but we've marked it amber which is just, we sit on the fence as neutral because you know, yes, the results and outlook are very, very good. So I just question the sustainability of its profits. That's my big question mark.
Yeah, well, I interviewed actually Gervais Williams a couple of weeks ago. I think it's his largest position.
Yes, I was quite surprised at that, but look, he's a smart guy, isn't he? So he's something I haven't.
Well, he was basically explaining, have you ever tried to contact, say, Centrica's or British Gas's call centre to ask about your bill and upgrading? And he says, just do that, and then you'll buy U Group shares, because the customer service for these guys is absolutely fabulous and just light years ahead of all the big operators.
Well, that's good to hear, but people don't generally buy on customer service in my experience. I think that's a nice, it's a nice to have, but it's probably not, people buy on price. It also had, if you look at the long-term chart, you went badly wrong in 2018, I think it was, and lost 80-90% of its value. And I looked into that, and it was basically due to sloppy, if we're being kind, accounting procedures. And it had to restate a load of historic numbers because there's a lot of estimates and guesses even in this sector, isn't there? And I'm wary of companies that drop huge accounting clangers and then tell you everything's fine. Also they had an issue with really massive bad debts not long ago. It turns out that they were offering competitive tariffs to businesses that they hadn't properly credit checked, who then couldn't pay. So it's not completely clean. It's had a checkered past, but look, we'll see what happens over the next couple of years. I see it's taken a bit of a tumble recently, hasn't it? I think.
I'll tell you, Paul. You are a tough man to please. The shares are 14 bagged in about 2 years.
No, I don't dispute that, and the figures are great. But with any share, you've got to look at, are profits sustainable? That was one of my mentors said to me, that is the thing you always ask with every company, because if you're buying into something that's just in a sweet spot, it could all unravel. So I'm only asking the questions, Paul. I'm not.
No. You're right. I'm pulling your leg.
I'm right.
No. I'm pulling your leg.
I don't mind being wrong, because it doesn't matter to me if I'm wrong, because I haven't. I don't own the shares, so it doesn't matter whether I'm right or wrong. But,
well, I think you're exactly right. Sustainability of the profits is absolutely critical for any share, no doubt about it. Okay, we've got another question coming in a similar sort of area. It's on it's Journeo, and the reason why I mentioned it was similar is because obviously we had the government releasing its plans to nationalise the rail franchises going forward, and what it did it did hit a couple of weeks ago Traxis, which does a lot of the software that goes into scheduling trains. And the question comes in from Mart. He's basically asking, any view on how it might impact Journeo? Again, the shares have done really well. This one does software and hardware for sort of ticketing and train signaling and this sort of, not signaling, notice boards, and also does stuff for buses as well, transport. But any views on it?
Yes, we like Journeo. We followed this one. We were a little bit late to the party on this one. A lot of the readers at Stockopedia actually latch on to good stories and tell us, the writers, have a look at this one, Paul, because we think this is good. And that's precisely what happened with Journeo. It did very well last year. We like it. Yeah, we think it's good. Just looking at my notes here on the other screen. Yeah, we've been green on it for a while, which is our traffic light system where we say we like it. Now, if I'm right, I think I haven't got the share price up, but didn't it peak around £3 recently? And then
it's just on the screen actually, Paul. Yeah.
Yes, I can't read the writing though on the right, so I've got it on.
Sorry.
Yeah, no, that's all right. And then it really plummeted, didn't it, down to a low of about £2.10. I remember covering it now on that day, and I said this looks overdone. I think there was no news from the company. That was it. Then they put out an update the next day, which something about a couple of new orders, but I think the orders were already in the pipeline forecast. And I commented on that day. This was quite recently, a week or two ago. I said, they've missed the opportunity. They should have said we're trading in line with expectations, and then it would have gone straight back up again, but they didn't. So I think they shot themselves in the foot a bit there. But look, it's on, we like it. 37 million market cap, trailing P's 11.7, isn't it? They seem to do an extraordinarily good acquisition, didn't they? Where they bought a business for the same as its own cash pile, which seems a bit strange. But no, I think Journeo looks good. Management seem to be highly regarded. Yeah, so I like that one.
No, I'm with you. Good, solid company run by a pretty good CEO, actually, Russ Singleton. So, thumbs up from my side, that's for sure. Okay, we just moved to the consumer sector. And I understand you're a high-frequency visitor to the Mary Shelley at Bournemouth.
How did you know that? Oh, yes, I say it in my podcast every week.
and apparently they do a very good fish and chips with a pint of Stella, which takes me to Wetherspoons. What's your latest on? It's Martin. I can't remember the guy.
Tim Martin, isn't it?
Tim Martin, iconic guy in the industry. They seem to be trading well. They must have done pretty well from the Euros as well. But what's your latest on Wetherspoons?
Well, I follow it closely as something I'd like to own in a sort of long-term, hold forever type of coffee can type portfolio. But it does have a tendency to get a bit too pricey. I love the differentiation of the business model. The drinks are so much cheaper than any other pub chain, seriously cheaper. Whatever your tipple is there, and the food's perfectly good, and the meal deals are fantastic. So it's highly differentiated, very high volume, rams the customers through, and it makes a modest profit margin. So very nice fundamentals of the business. Balance sheet is supported by loads of freehold property as well, and manageable debt, which they've recently refinanced on improved terms. So for me, it's all about valuation. When it gets to a PE of 20, no, too much. But recently, I reviewed it. Let me just put in the ticker. And basically, it had come down to a forward PE, this is, of about 15. Yes, here we are. This was on the 10th of July. It put out a trading update, which was in line with expectations. But I noticed that the broker forecasts have been sort of creeping upwards over a year, 18 months, and the valuation, the PE, has been drifting downwards. And I see actually in the last few days we've had a bit of a sell-off generally, haven't we? The forward PE is now down to, I know PEs aren't everything, but it's a good starting point. The forward PE is about 14 times, which I think for a differentiated business of this kind, is quite a good deal. I don't hold any personally, but I think I mean, it was looking at the chart. God, it was would have been a lovely buy, wouldn't it? In the end of December 22. There's no divvies I see forecast for that for Wetherspoons. I'm not sure if that's right. Have you got that? Have you got that on your screen, Paul?
No I've got there's no dividends at all. Yeah, I'm with you. I mean, I
don't know why that is. They paid one in 2019, then they stopped for the pandemic, I suppose. But I'd be looking for dividends to come back in. But And
what just more broadly, what just the sort of thoughts on the health of the consumer? Because you've got interest rates hopefully coming down. You've got real positive income growth, i.e. above inflation, you've also obviously got, you know, some minimum wages going up, which could impact the sort of, you know, impacts people like Wetherspoons, but actually be good for consumption. You know, you've got basically, I think the balance sheets for consumers are generally not bad at shape, actually, compared to a lot of the, you know, so the governments and stuff. So what's your overall view for the consumer?
Well, I think you summed it up perfectly there, Paul. You know, inflation's sorted. It's down to 2% again. Average wages, I think, what are they? Something like 5.5% or something, I think, or 5.1. I can't remember exactly. I'm very broad brush, as you probably gathered. I don't drill into the minute detail, because it's best to keep the overview, isn't it? So households have got now, real incomes are rising. You have got fiscal drag, though, from the frozen allowances, haven't you? And but yeah, the GfK consumer confidence numbers are fine. It seems to me that we should perfectly reasonably expect a fairly solid consumer spending recovery over the next year or two, barring something, you know, horrendous happening on the international scene. So yeah, I think, and that's what the stock market's telling us as well, isn't it? Really, you get quite a lot of shares, even if they put a profit warning out, the market's kind of looking through it in some cases for some of these things. The only thing I would say, though, with consumer stocks like the retail stocks, it's very difficult to pick the winners. You know, tastes seem to suddenly change. I mean, look at how Burberry on the luxury side has really fallen out of bed. I mean, I wouldn't touch that one. I think that looks horrendous, personally. But then you had Shoe Zone, you know, which did tremendously well for the last 2 or 3 years, with constantly beating forecasts. Now it's suddenly shifted to putting profit warnings out, and it's not really clear why. So you've got things like Topps Tiles, haven't you? Who do the tile retailing, that said no improvement. The DIY sector seems to be firmly so it's difficult to know what areas consumers are going to spend their money on. You know, the pubs are doing okay generally, aren't they? I think most of the pub chains have reported like-for-likes up.
Certainly the Mary Shelley's doing well.
I haven't been for a few weeks, actually, because I was getting a bit too pot-bellied, so I've had to cut out the midweek bites.
Okay. But what's also quite interesting, which perhaps people don't appreciate, when you look at this is a chart of the accumulated excess savings, you know, from the lockdowns. And the blue line, this is accumulated or cumulative. The blue line is the UK, and it's still going up as a percentage of GDP.
Yes, it's coming down.
Well, it is. The black line is the US one. It's coming down. This is what's surprising. This is from JP Morgan, and the European one has flatlined and slightly going up. And what's happened? Obviously, when we were in lockdown, we didn't spend, but when interest rates went up, you've got a relatively elderly demographic who, you know, basically are making a lot of interest off their investments, and you know, then that's gone up. Whereas in America, they've just basically just carried on spending, and that's why the excess savings have gone down. So you actually see overall household debt decreasing from, you know, a high of 100% down to now to roughly around about 80% for the UK. Whereas, and then you ask the question where the debt has gone. And it's actually gone onto government's balance sheets, because that's the sort of the government debt. And you can see America, you can see England, and you can see Europe, and that's how it's gone through the pandemic. So if the reason for showing that is that actually consumer purchases, we're not overall. I mean, that's a very general list, but overall, we're not in bad shape.
Yeah, well, that I'm surprised at the first graph, I have to say. But, you know, one of the readers, actually a couple of our readers who are very good on macro on Stockopedia, flagged up the fact several months ago, and actually Neil Woodford picked up on this in his blogging on macroeconomics, that the higher interest rates, which were meant to slow the UK economy, have actually pumped more money in than they've taken out.
Yeah.
And the data, you know, I've seen data that shows that, because, as you say, now you've got savers, you know, all these affluent pensioners on their final salary pension schemes, absolutely coining it in, getting 4 or 5% on their savings. Inflation's not eroding them anymore. So I think we need a complete rethink on this idea that you slow the economy by putting interest rates up. If anything, it seems to stimulate the UK economy.
I think, the missing piece of that jigsaw, though, is that it's stimulating the consumer economy. It's removing money from the government, who's got a massive amount of debt. But unless the government decides to effectively, you know, bring in the purse strings, which it hasn't done. It's carried on running a big current account deficit. Unless the government decides to consolidate its budget, reduce it, then overall you're just getting a surge of money from the government into consumers' pockets through that interest rate. But overall, if you did have the government deciding, okay, I've got to replace the funds that I'm paying all the consumers out through interest, then you would get a reduction, because it would basically put a dampener on spend of consumer, which is the bigger part. But we haven't seen that. The Tories didn't actually push the button on that, and neither of the European guys done it either. So I can't see them doing it either.
I honestly don't think, from what I've seen throughout my whole life of observing economics and business and finance, I honestly don't believe that the central banks or governments actually know what they're doing. I don't see any evidence that they think they can. The central banks think they can fine-tune the economy with quarter-point rate. It's nonsense, absolute rubbish.
Yeah.
So
I know. Okay, we've got a question coming in from IC4652. He's asking about Saga, which I know was a stock that you quite liked. It's basically split, I think, between a cruise line business and insurance. I think the insurance industry has been really tough of late, particularly things like Direct Line, very competitive, and actually a lot of costs increasing, particularly for car insurance.
Yeah, I got a bit fanatical about this during COVID as a recovery play, because the forecast was saying, it was on a PE of 2 or something. Actually, looking at the current forecast, it's on a PE of 3.4 with Saga, and it's a complicated one where people thought the debt was a killer, whereas I've always pointed out it wasn't, because of the maturity dates on the bonds, and one of them has now been paid off, and blah blah blah. But yeah, it's the recovery on the cruise ship and the holiday business has been a bit lackluster, but it seems to have been offset quite a bit by, as you say, ongoing problems in the insurance business. So I've sort of lost interest in it, really, but it has moved back into profit now. I don't believe the debt is a sort of existential crisis. I've never believed it was. So, who knows? It could be. There's a lot of upside potential from a PE of 3.4, isn't it? So it could be another Kia Group or another Capita. Those were similar, well, not similar in terms of what they do, but similar shares where the PE got down to 2 or 3 and everyone had written them off. And you suddenly find these things have got the potential to multi-bag. I'm not convinced Saga's, I don't think it's well run though. And if they could restructure the cruise ship loans and do a sale and leaseback or something, those ships are trading so well, they could actually have substantial net equity in them. So that it's worth people having a look at with fresh eyes, I think, Saga. Yeah.
Is there any synergy between the two divisions? Why did they put effectively insurance business with a cruise liner? I mean, I just can't see any sense on that.
Well, the strategy and the reason for the business has always been that it's a brand that older people trust. But I'm not sure how relevant that is to the modern world. I think, a lot of older people, certainly my mum and her neighbours, they're in their 80s or even 90s, and they're pretty savvy. They know that they can buy their insurance from anyone. I don't think they would particularly feel that they have to go to an old person's insurance company. So maybe the whole reason for Saga existing and its brand, who knows? Maybe it's had its day. I just don't know, Paul. But
I think when you look on the advertising, they don't just go for the elderly demographic. I think they go for anybody they can do business in, because they realise that they can't just exactly. Yeah,
I mean, it's one of those, isn't it? Because I did actually. I was going to mystery shop Saga. I booked myself on a Saga river cruise in Europe, but unfortunately, it was just when COVID kicked in, so I cancelled it. And I have to say, the service was amazing. I rang them up and just explained, look, I can't go. And this is about 2 days before the cruise was set sail. They said, yeah, no problem. We'll give you a full cash refund. Bang, money was in my account the next day. So there are interesting aspects to Saga. I wouldn't write it off. It's one of those things that you never know. It could yet delight and enthrall investors.
Well, if your big nights out are going on Saga cruises, then please don't invite me, mate.
I got a terrible reputation.
Okay. Now, you mentioned Capita, and this is a big turnaround opportunity. It's come down. It was an absolute darling. FTSE 100 business about 20 years ago. Really sort of like it was owned a lot by Neil Woodford, and then it just dropped out of bed, got caught in a lot of contracts. It's an outsourcer, largely services the public sector, contact centres, and the financial services area. And I actually interviewed Richard Staveley of Rockwood.
I know, brilliant.
And he basically said it's a blind spot of how much hidden value in this business is. And then just on cue, about 3 or 4 days later, they decided to sell their software business that I'd never even seen in it for 200 million quid. It cleared the debt. Anyway, what sort of piqued your interest on Capita? Because there could well be something in here.
Yeah, well, we've been flagging this one for about a year as a potential turnaround on Stockopedia, but it just carried on going down. So it's been a tough one. But yeah, I thought what Richard said about it was, I mean, he's just a genius, isn't he? Absolutely love listening to your podcast with him. He just does that extra layer of research, of really getting into the business model and the competition that I just haven't got time to do. So I always learn a lot from him and Christopher Mills. So, yeah, but the latest news from Capita, as you say, was on 9th of July. It rose 20% on the day, but it's done the usual thing that most things do at the moment. They just drift, don't they, after a spike up as people just grab the profit. Disposal of Capital One, a standalone software business, as you say, sold for 200 million on a 10 times EBITDA multiple. So, of course, that's much, much higher than Capita's EBITDA multiple. So, therefore, it adds value, doesn't it? And it clears all the bank debt. This is the thing I thought was interesting. Although I would imagine because of the big revenues, you'd have quite big intra-month gyrations in the cash and the debt position. And it does benefit from favourable working capital. So its balance sheet as a whole is still actually quite ropey. It's not a good balance sheet. But if you can keep the plates spinning and you keep getting paid up front by customers, it shouldn't be an impediment. So I think it's very interesting. And they also said, obviously, they're going to lose 19 million a year in profits from the division they've sold, but they actually said we're going to keep maintaining our medium-term guidance because we think we'll make it up elsewhere in cost savings and so on. So look, the only thing I would say is that I think Richard's idea of it getting back to 6 or 7% operating margins is a big ask. That's not something we can just be blasé about and imagine that's automatically going to happen. So that's my main reservation on it. But it's achieved those margins in the past. So yeah, I think it's an interesting one to do more research on. Yeah, so I've coloured it here green. So yeah, we like it.
And it might benefit from things like reshoring and nearshoring and stuff like that, because people now realise actually sometimes it's better just to do things locally. And if you can put in good sort of like AI software or good software in your contact centres and your support, then your cost base actually can be just as cheap as it is out overseas. So you might find this.
I was going to make the same point actually on AI, although I have to say from what I've seen of it so far, absolutely not an expert at all on it, but just as a layman, I'm very skeptical. I think, it's, for example, on Amazon, it's now so difficult to actually get through to somebody to sort out some problem, like the Amazon lock that I go to. There's something in there I need to collect, and it's broken. Somebody's punched the screen in and vandalized it. And there's just no way you can. The chatbot says, "Is the product you bought broken?" No, the Amazon lock is broken. These bloody chatbots, they're rubbish, absolute rubbish. So I think, if Capita can actually bring in some intelligent software that actually works, there've got to be big savings from the call centers, haven't there? But I'm skeptical about, if they can actually get software to work as efficiently, as resolve problems as well as a human being.
Yeah, well, there's got to be an opportunity in HMRC because they don't even answer the phone.
Yeah, I believe so.
It must be. Okay, just sticking on the consumer thing, we've got Jet 2, which I know you quite like. It's basically a UK holidays and package tour business. It came out with a pretty reassuring trading update. You had earlier in the week, though, Ryanair coming out with an absolute mare saying that they're seeing significant pricing pressures. That's the ticket fares are a softening off, and their costs are actually increasing. But then, similarly, you then had EasyJet coming out with quite a confident outlook for the rest of the year. So it seems to be quite sort of like spotty on which airlines to go for. But what's your sort of your latest thoughts and on Jet2?
Well, you're quite right. You've preempted a lot of what I was going to say there again, Paul. But you're absolutely right. I mean, I reviewed Jet2. We've been positive on this for a while, just because the value and the growth and the track record, everything on it is so good for Jet2. But on the 11th of July, it put out its March 2024 results. So I just went through the numbers, and I thought these are so good, and the valuation is so cheap. Fantastic balance sheet, which incidentally you've also got at Ryanair and EasyJet. They're all on about 2 times tangible book. So these are pretty solid, very solid businesses actually. But you've got the obvious risk, haven't you? Any sort of pandemic resurfaces, your airline, your business is shut down instantly. So whether I would necessarily want to own an airline, I'm not sure. But it also Jet2 also said trading year to date is in line. But it says people are booking holidays later, so it doesn't want to give specific guidance until the busy summer season's done. But as you say, Ryanair, then that's dropped a lot, hasn't it, Ryanair, recently? But it does seem to be more company specific with Ryanair. I don't know why.
Well, these guys do end-to-end. These guys are end-to-end package tour holidays, so they'll pick, effectively. They've got the airline, they've got the hotel, they'll do the sort of like the collections from your airport to your hotel, take you back. Whereas Ryanair is just really point to point, and they'll dump you off in an airport miles away from Brussels or Amsterdam.
Yeah, no, that's a very good point, Paul. And I mean, Jet2 is just such a brilliant entrepreneurial business. I mean, I can remember discussing this with my friend David Stredder at an investor event years and years and years ago, and it was called Dart Group, changing the name to Jet2.
Oh, yes, I know.
Yeah, and it was between 50p and £1 a share, and it just went sideways. It never went anywhere, and it was on a PE of about 4.6 or something. Just stayed cheap forever. So we just got bored and sold them, and it then went on to 15 bag.
Yeah,
brilliant entrepreneurial management. I think he's now retired, isn't he? Philip something or other. And but I think you get that entrepreneurial culture. Then they decided to start doing the package holidays not that long ago, and they've done it phenomenally well. And my readers, interestingly enough, because we've got, I think, I'm not sure of the exact number, but I think it's over 10,000 subscribers. We get great scuttlebutt from the readers, and all positive about Jet2. They all said, one guy said it's my go-to airline. Customer service is off the scale. I found an industry report a survey of customer service across the whole economy. Jet2 was the only travel operator in the top 50. It was right up there. So I put in an excerpt of that. So I do think there's something distinctive and better about Jet2. So I think it looks great. Although it's got a huge number of new planes on order, I believe. So one of the readers did point out it's going to go from net cash to net debt. But that could be an opportunity, couldn't it? They've obviously got, and they operate from all these regional places up north, don't they? So really, where my family live, up in Cheshire and further north, Jet2 is basically the airline they all use for their flights and their holidays, and they absolutely love it.
Yeah. And I think it's quite normal, given what the weather's been like in the UK, for people to delay their holiday plans right into the last minute, because then they can decide then where's the best place to go. So I think that's pretty normal. We've got a question coming from Alan Holland. He says, "Dear Paul, do you use exercise bike, or is it a clothes horse?"
We were laughing about that before we came on. Do you know what? The white thing there, I do actually use. I use it nearly for an hour. Every day, because instead of handlebars, it's got a desktop, so you can just put a laptop on it, and then you can actually type away on it. It's fantastic. Well,
Adam likes it and says, do you fancy selling it to him? What price is the price?
I should do a commission deal with the company, shouldn't I? That makes them. They are brilliant. They are brilliant.
We've got a question coming from George Roach. He's asking about Volex. Any thoughts on the cables business that goes into electric vehicles and also medical? It goes into quite a lot of high value. I think they've got a big production sort of nearshoring. Got it in Mexico to service North America, and they've got Turkey to service to Europe, and they've got a place out in Europe. They had I think a lot of question marks were over XP Power, which is in a similar sort of area, and that had a bath. But Volex seems to have really not put a foot out of place. What's your latest on this one?
I mean, well, I've liked it for years since the turnaround really gathered pace under the 25%, I think, executive chairman shareholder Nat Rothschild. And like you say, it just doesn't seem to put a foot wrong. The March 2024 results were out on the 26th of June, excuse me, which I thought were very good. I've been marking this green now on my color coding system for a long time. It was slightly ahead of broker consensus numbers for March 24. I'm just happy with everything. It has taken on more debt, but it seems to be very, very good at making acquisitions. It buys things it knows in the same, electrical cabling niche, but it'll buy things, that I think it courts these companies for several years, gets to know management. They're often retirement sales, so company culture is just as important as price. And they just seem to be very accomplished at bolting on specialists in particular niches that they can then cross-sell to. They can then get the synergies from negotiating, obviously, bulk buying of plastic and copper, which are the main ingredients, I think, aren't they? And it like you say, Paul, it doesn't seem to have put a foot wrong. I don't understand why it's this price. I think so the main opportunity on Volex, I think, is just a simple re-rating of the shares. As hopefully once we're into a new bull market, the market will say, well, actually, this is actually a very convincing, successful buy and build. It should be on a PE of 15 or 17, not a PE of 12. So there you are, assuming that thesis is correct. You've got a 30 or 40% uplift in the share price. I wouldn't say nailed on, that's being too emphatic, but do you know what I mean? The opportunity is pretty obvious if we're patient. You don't get much in dividends, though. I prefer things where you get a better yield. It's only 1.2% here, and price to tangible books 11 times, so you've not got a lot of asset backing, and there is a fair bit of debt there, which is rising. But if your exec chairman's called Rothschild, you're not going to have any problem. You're not going to have a problem with bank facilities, are you?
No, you're exactly right. Plus, I think that just the dip in the share price was just obviously people getting a bit concerned of what happened over in XP Power, and also there has been a bit of destocking in EVs, but I think that's now through. And just normal sort of electrical appliances and stuff like that. But now the destocking is finished, then I think data centers are going to be growth. I think EVs are going to be obviously big going forward, and I think they're restocking in some of the medical side, the MRI scanners. So I'm with you. And if they can carry on delivering the sort of 9-10% EBIT margins, there's no reason why this one shouldn't be trading at least at 1x sales. And if that was the case, it'd be over $1 billion market cap.
No, I think that's right. And I've lost my train of thought now. Carry on, Paul.
Yeah. Okay, good. Well, let's move to we've got another one on the consumer. Yeah, he's asking about Kate Box as well.
Oh yes, I like this one.
Yeah, I know you've had a look at it because they did really well during the pandemic when they were basically the only shop open to get fresh cream cakes. And sort of party cakes, and then when it opened up and we had a really hot summer, people decided not to have cakes, and they had a couple of accounting issues which they had to sort out. So the shares took a bath, and then they got basically a sort of prospective bid from an Australian cheesecake company round about. I think
that was a bit peculiar. That didn't make sense to me. But anyway,
the shares have rallied hard, over the past couple of years. I think they got to a low of about 70p. I don't know if you want your latest thoughts on this one. There you go.
Yeah, no, I like it. I was skeptical on it, going back a couple of years when it had all the various problems. But no, I think it's just good, solid value share now. I think they've clearly dealt with the issues. The balance sheet's nice and strong. I don't think it has any debt. It might even have net cash. You got a lovely dividend. Lovely dividend, 5.2% yield. It's a rollout story, obviously, of the shops, but the revenues only look small because it operates through franchisees, so you don't get the full store revenues showing. I think it's got a couple of freeholds of a distribution center as well. I mean, it ticks all my boxes really for a nice value go-up share. Yeah, I like Kate Box. And then here we are. What's that? 11th of June, I think. The update came out. Results in line with expectations. That was March 24. Profit before tax was up 10%. Yeah, continuing to roll out through franchisees. Looks good to me. I mean, look, it's not going to blow the lights out, is it? It's not the sort of share that's going to be a 10-bagger, but I think it's a nice, I mean, you know, self-funding rollouts are good. And if you can get one on a reasonable PE of about 13, 14 times, yeah, I like it.
I think international franchise
of it, Paul, yourself.
Well, international franchise businesses, even on the consumer side, they tend to go at 14, 15 times EBITDA, and I can't remember exactly what this one is, but I think it's only about 8 or 9. So there's significant potential opportunity. If somebody wants to put a number on them and they've got cash on the balance sheet, then you know, there's definitely an opportunity.
Yeah, okay, 8.5 times EBIT. Yeah, I don't think management would want to sell, though. Do you? I mean, they control the company still. I think the founder, doesn't he?
Well, I don't know. If the offeror puts a cherry on top of the bid, then they may do.
Yeah, true.
With a few sprinkles on top of that cake. Okay, right.
Have you mystery shopped their cakes, Paul?
Yeah, I have. Yeah, they're absolutely fabulous. Absolutely. I've probably mystery shopped their cake shops as much as you've mystery shopped what's the Mary Shelley.
Very good.
Okay, we've got another one on that. It's got Whitbread, which is obviously owner of the Premier Inn brand. Affordable, sort of clean and you know, easy to access accommodation that is chimed with most consumers for years and years. I mean, it's my go-to provider for when I'm traveling at all. So what sort of attracted you to this one? Seems to be a good rollout in Germany as well.
Everything, value, margins, everything looks good on it. Everything apart from the share price. I see it's down again, down to £28 a share. I think from memory we did cover although it's a mid cap, I will cover mid caps if I think they're interesting and good value. So I did a little while ago say when it was £34-35 a share, I said it's got a bit ahead of itself. That was it. That was in the spring of this year. I said good business, but the price is a bit up with. But it's since come back a lot. It's dropped. What's that? Almost £10 from the highs at the beginning of 24. I think it's very, very good now. 5.1 billion market cap on Whitbread. Forward PE 13 times. They have had issues with obviously the staff costs because that's quite a high overhead, all the staff they have to employ. So you'll see the broker forecasts have actually been reduced in the last few months. You're right, they're rolling out Premier Inns in Germany now as well. That's still very small, still mainly a UK business. The thing I like about it is the profit margins are really good. It's far better profit margins than for, say, pubs groups, although it's got its own little hospitality business built in, and it's converting some of the slower ones into more hotel rooms. Looks very well run to me. The balance sheet's fantastic. It's full of freeholds. So you're getting really, people look at the net debt figure and think it's enormous, but of course that's leases, which is not real debt at all, in my view. But if you read the annual report, I mean, I've covered all this in quite a lot of detail in my Stockopedia report. So I've done the analysis for people, at least, you know, the basic numbers. They can then form their own view because we never recommend things. But I think it looks a very, very healthy business. Lots of independent hotels closed down in the pandemic. A lot of the properties were repurposed for other things. And there are very few national branded hotel chains in the UK. You know, you've got Travelodge, you've got Premier Inn. I mean, I would struggle to think of any others. I mean, I think things like Holiday Inn, they're franchised, aren't they? And there's a few, and Marriott maybe, and whatever. But at like you say, it's your go-to type of thing. Funnily enough, it more or less, I'm mystery shopping it this weekend. I'm going to Guernsey, taking my fold-up bike with me and spending a weekend cycling around Guernsey, as long as the weather's better than it is now anyway. And yeah, I'm staying in the Premier Inn there. So I'm going to mystery shop that and mystery try out their all-you-can-eat breakfast buffet, which I'm looking forward to a great deal.
Yeah, I'm told the breakfasts are very good there, that's for sure.
Yeah. So yeah, Whitbread, have a look at it and let me know what you think. You know, everyone's got a different take on things, but I think I haven't heard any convincing bearish arguments on Whitbread.
Yeah. Okay, good. Let's switch sectors. We've got Ben Sharman just asking about the building materials sector to see a rebound. I've seen the rebound in the housing, obviously, but the building products, because we've had a wet spring and a wet summer, and then the dislocation caused by the early general election hasn't yet fed through into putting in doors and windows. He's interested in Lords Group trading, Eurocell, and the Brick Boys, Michelmer's. But I know you quite like also the Norcros, don't you, which does sort of like kitchen and alley mask. An alley mask, yeah. Do you want to do quick thoughts on Norcros and other areas, other interesting areas? Because it seems a really good place to go hunting, actually.
It does, doesn't it? I agree. I think this is one of my favourite sectors to go hunting in, and there are lots of nice companies in the small cap space in the building materials. I think the larger ones, the larger companies, is it Marlowe or something like that? I can't remember, but
they're on services. I think they're regulatory services.
Is that the IT thing? Yeah, no, I'm getting muddled up. It's some Marley. Oh, I can't remember. But anyway, the big ones don't strike me as value. You're being asked to pay up front for a recovery. But the smaller building products companies, I think there are some really nice opportunities. I think I put Eurocell on my top 20 for this year because it's got a lovely balance sheet, loads of freehold depots. And it's, here we are, Eurocell. You get a 5.6% yield. You're on a forward PE of 8.9 times. You've got a lovely strong balance sheet. Price to tangible book is only 1.6 times. And remember, this could well be bottom of the cycle earnings. Yeah. So once you start factoring in a nice recovery, I think they do. Don't they do windows?
Doors and windows, but they make it out of recyclable plastic, I think.
Yeah. I just think it looks something that to me seems that it's actually trading pretty well during awful macro conditions. And it's reasonably priced, probably on low point of the cycle earnings. That to me screams there's something that should hopefully re-rate in a recovery in 2020. I think the house builders are generally saying don't expect a recovery until 2025, I think, aren't they?
Yeah.
So we seem to be getting consistently the same message from the house builders saying, yes, things are green shoots, all the rest of it, it should recover, but don't expect any fireworks until next year. And then the government, of course, wants to encourage house building. And plus you had this renovations DIY boom, didn't we, during the pandemic? So we're now suffering the aftermath of that, aren't we? The hangover, where people, only need a new bathroom every 10 or 15 years, don't they? Or when they move house and don't like the style of the previous owner, So you'd expect quite a deep and potentially quite long lull. But Norcros, I looked at very recently. This is one of those permanently cheap shares, isn't it? That just never seems to re-rate. It's a good business, it really is. I reviewed the March 2024 results on 18th of June, and the conclusion I came to, I'm very positive on it, it's cheap and the outlook's okay. The interesting thing is that the legacy issues on Norcros are now pretty much dealt with. The pension deficit is only sucking out a relatively modest amount of the profits, because as you know, it doesn't go through the P&L, but it's a modest amount. The South Africa business is not trading particularly well, but again, it's only about 10%, if that, of total group profits. So these legacy issues now are a small beer and don't justify the deep discount on the shares, in my opinion. I think it's quite a nice underappreciated quality business, Norcros and XR. So have a look at that one, but just don't expect any fireworks, because it seems to stay cheap forever. Some shares are just like that, aren't they? I think you get good divvies, don't you? 4.5% dividend yield while you sit and wait, which is the same as you could get in cash on the bank, and you might wake up one morning and find somebody's bid for it,
Yeah. Okay, good. Let's switch sectors to the industrial side. We've got Zotefoams, which I know is a sort of like quite a larger position of yours. It does specialist foams for Nike to go into its sort of Air Jordan shoes, but also does foams for automotive and other industrial applications. And I think it's also got this resource recycling and carton business that could well be just transformational for the group. Anyway, sort of what's your overall investment thesis for the company on this one?
Well, everything you just said.
But I mean, the shares have done very well. The shares have done very well, haven't they? And it's
yeah, we got overexcited about this. The market, and I piled in and bought loads more of them, pretty much almost at that peak you see at about £5.50. So my market timing was pretty hopeless. But I'm not bothered about that because I think the story, it's basically a good, solid business that produces. It's priced reasonably attractively on a forward PE of 19 times. It is capital intensive, but it generates a good return on the return on capital here is about 12%. Operating margins about 12%. Not bad. It's got modern, updated factories. It's done all the capex it needs. It's got a lot of know-how. So they have an exclusive agreement with Nike, which was just renewed for another 6 years, I think. And they do also things like aircraft seats, the padding for that, light high-performance foams, where they've got a lot of know-how. I think it's very well run, very good business. Probably not madly exciting as it is, but as you say, you've got this optionality of the resource product, which is now very close to commercial launch. The company are telling us, and there was a really quite radical change in tone, I think, on the last couple of webinars from management, where you really get the feeling they're starting to say things like, we're really excited about this, we think this, if it comes off, the potential for this could be pretty enormous, but it needs a lot of funding. So they're talking about third-party deals, they're talking to sector leaders, bottling companies, drinks bottling type companies. So you could get, it seems to have been technically proven up now, but I don't think we've actually had a definitive statement from the company that yes, this definitely 100% works. I believe it's still in final testing. So the risk is obviously that something horrible happens and it infects everyone with germs in the drinks or something and has to be just scrapped.
Yeah, I don't think that's going to happen.
Well, you never know, do you? So I think that is the down, but everything's risk reward in investing, isn't it? So I would say the risk, well, you might get, if the resource project fails, you might see the shares drop 20-25%, and then maybe sort of slowly recover a bit. So that to me is the downside risk, because the core business supports most of the share price. So I'm happy to risk that for what could be, an absolutely open-ended upside if resource really takes off. So good risk reward, I think, but it's the element of guesswork, isn't there?
Yeah. Well, I mean, I'm not in the shares, but I can't see them being a technical problem. I think the product is just about there because they wouldn't be getting keen about it. My only sort of question would be, externally, is there any rival technology or rivals out there? I mean,
good point.
That's the hard bit for you and me to understand. What else? Because there's so much stuff that's not public that you don't know, do you? And you just have to decide. Yeah,
that's a really good point. Yeah. No, I take that completely. Yeah.
Another one which has done really well for you is Intercede. Now you spoke to me about this one about sort of 3 years ago, and I think you were in it and then popped out. But the shares have been a total sort of like rocket ship. And I guess the question is do you keep running this winner, or do you sort of like top slice? Because I mean, you just got to look at the chart. It's been fab.
Yeah, it's very good, this one. I bought back in at around £1.10, £1.15. So it was a pity because I originally held them ages ago. But I don't think it matters, because if the story changes and improves dramatically, you just forget what you originally bought or sold for. It's irrelevant. And the news flow Intercede's been very, very good. It's a specialist in online identities. It's got a client list literally to die for, unbelievable client list, and they're now selling through. The CEO's done a sort of 5-year turnaround on it in stages that he set out. This is what we're going to do first. This is years 1, year 2, year 3, and he's done exactly what he said he'd do. And then he's sorted out the balance sheet, sorted out the product. Now he's set up the relationships with systems integrators, particularly in America, because it mainly sells in America. Amazingly, for a little company in Lutterworth, it's managing the cyber credential managements for a considerable number of US government federal departments, and the big aerospace companies, Boeing, Airbus, all the client list is just incredible. But they are now selling through these systems integrators. And on their Capital Markets Day, which I listened to online, one of the big systems integrators from America flew someone over to Lutterworth to appear on their Capital Markets Day and absolutely extolled the virtues of them and said they're a delight to deal with. They're the most professional company. We want to sell this product to all our clients, and you couldn't get a better third-party validation than that. So, and again, the demeanor of the CEO, who I've known for 5 years or so, he's just so much more upbeat now. It's not anything he actually says; it's kind of the way he says it. You think, he's almost kind of suppress a smile all the time, and little things like that. You think something's happening here that's good. I know that's all subjective, and even might sound rampy to people. I don't mean it like that, because I'm not going to sell my shares. I'm in this one for the duration. I think it could do very well. It's only 86 million market cap. It's got a lot of cash. I think the most recent
17 million, I think, something around that.
Net cash, yeah. It does get paid an element up front, and you do have some contract renewals that are quite large and lumpy. But I think I'm right in saying they've never lost a major client. I think that's right. The life, once they get into these big government departments and things, you've got a 10 to 20 or even longer year recurring revenue, which I think deserves a premium rating. So yeah, I'm really, really keen on Intercede. It's about my third or fourth largest personal holding. Not trading it. I'm just in for.
I mean, when it comes to value, I'd have the same view, because when you look at the valuation, optically it's 33 times forward PE, so it looks a bit expensive. But also it's 4 times sales. But the reason why actually this could go for a lot higher than that is this is where you need to sort of like put your private market valuation on it, because I'm just guessing if it's a software business, it does 90% gross margins, okay, and that's the variable. And so if to a buyer, you can basically, let's just say you paid 10 times, double the current share price, you paid 8 times sales, 90% gross margins, because you could basically take out most of the overhead because you've already got it, your sales, support, R&D, they're already in that software business. That's then essentially, actually, the PE you're buying on it is roughly right. It's basically about 8 times. It'll be, 8 times EBIT or 10 times EBIT. Frankly, for a software business with, as you say, blue chip customers you could kill for, they're absolutely, it's dirt cheap. So this is where a lot of the software businesses, the public markets get it wrong, because they ignore what the private market will pay for these businesses, because the
that's a good point.
The synergies are just enormous. They're more than double the business, and they're cost synergies, so they're pretty certain.
Yeah, it is. I mean, I don't even use PE for this type of situation. If I find something that I think has got that potential, explosive growth on, like you say, 90% plus margins, because I'm pretty sure that Intercede uses sort of standard code. I don't think they bespoke it for each client. And again, they had a couple of users of the product who say, it just never goes wrong. There are hardly any calls to support. It's put in and it just works, and so I think you could, and each they won a big one-off contract, didn't they? I think that's why we saw a large spike in earnings. But that demonstrates the point, doesn't it? That suddenly its earnings went from 1.3 million, this is after tax, to 6 million in 1 year, just due to one big one-off contract. So imagine if they start winning a series of these things through all these systems integrators that have only really started selling this product in the last year or so. I just think you've got that. I look for things where there's really potentially massive percentage growth, and I think they've got an opportunity here. I don't know whether it'll happen, but I think there is an opportunity here. So fingers crossed.
Okay, good. We've got a question coming in from Steve Lewis. He's asking about Serica Energy, which is really, really deep value. These are North Sea oil and gas producers. The share price has obviously been hit because of the government deciding to not issue any more North Sea licenses and increase the windfall tax by another 3%. So the sentiment is terrible, but that seems to be more than reflected in the share price. I don't know whether you've got any views on the North Sea oil and gas producers, because their valuations are all extreme lows almost. I mean, they really, really are, given that these kind of guys have been producing and generating, a lot of income and a lot of cash.
Well, I'm not going to start spouting BS here, because my readers will tear me to shreds. They know full well that I don't know anything about oil and gas. But just look at the stock report, though. 500 million market cap, forward PE 3.2, 17% dividend yield. I do remember, and trading well below book value. I do remember actually the readers were discussing this the other day, and one of our shrewder readers with a very good track record, he flagged up that they've got, I think, quite short lifespan remaining on the fields, and then you've got to accrue for all the cleanup costs. So I think those are the issues to do a deeper dive into. But what's your view, Paul? Have you looked into this one?
Yeah, I think the decommissioning costs are actually, when they bought the fields to do to get the extra oil and gas out of the ground, they left those with the sellers before, so it didn't transfer to them. So I remember looking at it. I don't think they've hardly got any decommissioning costs on their own balance sheet. So it's all pure cash. And so it comes down to is new technology squeezing, the final drop, the bit of gas out the actual fields. And I mean, just optically, the government's mad to not get that type of oil and gas when we're looking for energy security. They'll get more tax. They'll get more tax by increasing it. So anyway, I mean, I think they'll reverse that at some point in time. I don't own them.
They put this loony Ed Miliband in charge, haven't they? It's one of these eco maniacs, and I've got nothing against eco. We all want eco, but obviously we need gas as a transitional fuel for maybe up to 30 years, because for when the wind's not blowing, you've got to have backup. Gas is the perfect thing for that, and we've got shed loads of it on the doorstep with all the infrastructure there. Instead, if they stop us exploiting the North Sea, we're going to have to bring in LNG from halfway around the world from dirty producers. So I just don't think they've thought it through. But anyway, I'll stop ranting.
Okay, we've got another one from Edward Hard. He's asking about Billingtons, which is that a steel producer basically for buildings and for infrastructure. Share seems to have done
BILN.
Yeah, that's it. Share seems to have done pretty well. I'm guessing, and that is on just increasing on the sort of construction. I mean, there's massive construction and infrastructure needed. That's for sure. Things like water, railway, this sort of stuff. I don't know. I don't know whether international or UK.
Yeah, this one looks quite good. I remember Severfield is the larger structural steel one, isn't it? That we have looked at recently. And I remember going green on Severfield, because every time we reported on it, we said, oh, macro, demand's going to dry up, blah, blah, blah. But it never did. And they kept putting out updates saying, actually, we're winning loads of orders. And like you say, all the sort of infrastructure stuff. I think Severfield operate in India as well, don't they? So we like Severfield. So here we are, Billington. We last looked at it on not for a while actually, 22nd of March, when it was £4.50. Oh, it's up a bit since then. And I looked at and I just did a quick review of it when it announced some contract awards. I've said here we like the numbers for Billington. We're amber green, so we moderately like it. Good balance sheet, decent dividend yield, and worries about a cyclical downturn seen unfounded, given news of 6 new contracts. Record order book, all further underpinning market expectations. So yeah, this looks good, doesn't it? Although I must caveat that with this was 4 months ago, so I haven't checked the latest news on it. But if we were in March now, I would say yes, like it.
I think it's going to be good. I mean, for sort of reshoring and infrastructure and anything like that, because obviously, and putting data centers up is another one. And they've talked about renewing or building more hospitals and schools. And so all that sort of stuff should be. I mean, it's not the kind of stock I would personally go for, but I think there's a tailwind behind that industry, particularly as interest rates start to fall as well.
Yeah.
There's another one coming in from Steve Lewis asking about Pressure Technologies, which is it's got got two divisions. One of them's an oil and gas precision products business that is being sold off at the moment. It's getting towards the end. And then the main one is their Chesterfield cylinders, large cylinders business that goes into astute submarines. I know Richard Staveley quite likes it. I think Lawrence Hulse of Dowgate also quite likes it. I don't know if your latest views on this one.
It's quite interesting, actually. I didn't really want to look at it because it's quite complicated and very small, but the readers persuaded me to have a look at it. I've marked it amber. This was the interim results, because the H1 results that I reviewed on 25th of June were pretty poor, and the outlook was underwhelming as well. I know the fund managers, especially the Harwood stable, are trying to sort of engineer a turnaround there and a restructuring, but I think they're finding it, you know, a bit of a slog. It's and my problem is, I think the balance sheet needs more liquidity, and we're not talking big amounts of money. You know, a smallish placing is being supported by shareholders with, I think, a convertible loan and various other bits and bobs. Lloyds Bank, I think, pretty shamefully pulled a £1 million facility or something. They're pathetic, Lloyds are. I've had some horrible dealings with them in the past. They just don't support businesses, and so the balance sheet, I think, does need a bit of a sort out at Pressure Technologies. And I'm just querying, why are they selling off the division that's actually now performing better?
I mean, I think I get it, because the guy who's helping them sort this on out, Richard Staveley of Rockwood, he did exactly the same with Crestchick, and he got because they had two divisions. They had an oil and gas parts business and the effectively the load back business in Crestchick. And by selling it off, it meant the management concentrated on the fast-growing load bank business that eventually got bought out by Agrico. So he's trying to, and the board are trying to sort of like do a replication of what happened so successfully at Crestchick. Because the shares at the bottom were about 70p for Crestchick and got taken out by Agrico at £4. So I think that's what they're trying to do.
Terrific success. You did well on that one, didn't you? I remember.
I had to do well on one. My portfolio is terrible, but.
Oh, you're too modest, Paul. So, look, all I do really with my work on Stockopedia is I just review the facts, figures, and forecasts on that particular day. You know, I'm not doing the level 2 thing that Richard Staveley and Christopher Mills and all the others do, of then saying, well, what can we do here? How can we? Do you know what I mean? That's the clever bit. So on my sort of simple level 1 analysis of the numbers, I didn't see a lot of attraction to Pressure Technologies. But if they can really engineer a good turnaround at Chesterfield Cylinders, then yeah, it could be good upside. But I've never really understood with Chesterfield Cylinders why it doesn't make more money. You know, it's this global specialist in these real niche area, and it did a few years ago, a long number of years ago. It was highly profitable for a while, but it hasn't made any money really since, and I just question why.
Well, we're not at the moment. We need to produce a shed load of submarines, and most of these large cylinders are going to go into submarines, particularly into sort of the AUKUS.
Oh, isn't there hydrogen storage, or did I imagine that?
Yeah, there is, but that's longer term. It's the defence side which will boost it, no doubt about it. Okay, good. We've got one coming in from.
Do you like Pressure Technologies yourself, Paul?
I haven't got shares in them, but I can see it as an unbunbundling play. And anything Richard Staveley waves his magic wand on gets me interested. That's for sure.
I know what you mean. He's a genius. Although the thing you've got to remember with these fund managers is, because they go in size, once they're in, they're stuck. You know, so if they suddenly realize, oh, actually, this is not going to be as good as we thought. You know, whereas we can nip in and out. That's the beauty of it, isn't it?
Yeah, but the advantage is if it does have a couple of tough periods or goes a bit pear-shaped, then these guys roll their sleeves up and get their, you know, they sort it out, change management, get the strategy sorted. So you've got a bit of a put option on their expertise, because you know they don't just walk away; they get it fixed.
Yeah, very good point.
Anyway, we've got Martin White. He's asking about Warpaint. So I don't know if you've been putting any cosmetics on there.
Yeah, we've done so well on this one. One of our big successes in the small cap value report, we spotted the potential there fairly early on, and I interviewed the management. I think that was a couple of years ago.
It's been pretty disappointing. It's only gone from 70p back in 2020 to £6.
I know. No, it's fantastic business. There's, as I said in the interview I did with the CEO, it's just the simplest business model you could wish for. You know, they get this makeup, it's decent quality, customers love it, and then they just roll it out to more and more shops and globally. You know, the shops that stock it, it sells well. So then the initial trial at 50 stores goes to 1,000 stores. You know, and it's just doing more of the same, really, and they've only scratched the surface of a huge international market. So I don't see any reason why the growth should stop. The question, of course, is what do you pay for the shares? That's the big question mark, isn't it? Now, it does tend to thrash forecasts. So people who bank the profits because it looked too expensive have regretted it, as you can see from the chart. I don't know. Forward PE is currently 25.8 times, which is a lot, no doubt about it. But as I say, it has tended to smash the forecasts in the past. So, I mean, look, on fundamentals, I absolutely love it. It's one of my favorite shares, and that has been for several years. Sod's law. I always waited for a dip to buy them. Didn't happen.
Now, more broadly, I mean, obviously the shares have done well. The business is still knocking the ball out of the park. You've had two large, the other management, you have the CEO, founder, and I think somebody else. They've sold two large blocks of shares, about £1.5 million each, I think, or a significant sum anyway. And just how do you treat that more broadly in terms of director selling? Because it looks totally, you know, in line, just reducing your exposure, because it must be of their net wealth enormous amount. But how have you sort of like, you know, interpreted it?
Each situation is unique, isn't it? I mean, none of us like director selling, but as you say, these guys are hands-on entrepreneurs. They built a business that's gone from being worth a few million to now nearly 500 million, and they owned nearly 50% of it, the two founders. So it's basic risk management. They'd want to take some money off the table. The figures I've got here, they sold this is Sam Bazzini and Owen McLeod. They sold 3.5 million shares each. So it's a big chunk of change when you're selling them at whatever it was, £5 or something. But they've still got nearly 16 million shares each remaining. So, you know, 41% their shareholdings combined after the director selling. I mean, that's plenty of skin in the game, Paul, isn't it? It really is.
Yeah.
So,
no, I mean, I'm amazed they haven't sold before, to be perfectly honest. I'd just be scared. I'd just be scared to have that much amount of money in one particular stock. You're just running, you know. I mean, let's be clear about it. We all know the world is difficult and uncertain, and nobody can sort of like decide what's happening. I mean, who knew that, say, Donald Trump had an assassination attempt, you know, that was going to happen. And so anything, you know, these things can really come from left field, a pandemic, whatever it is. So to have an enormous amount of your family's wealth tied up in one particular company, it just seems totally prudent and sensible to do what they did.
Yeah, totally agree. So yeah, for me, that wasn't a negative particularly. I think I might have slightly panicked on the day, and I think they did take a bit of a discount on the price, which I'm not too keen on. Was it 6 or 7% discount? That's complete guesswork. I can't remember exactly. But, you know, particularly when companies, you know, saying, oh, we're doing this to satisfy institutional demand. Oh, I can't say what I was going to say, unless you've got a bleeper. But, you know, they're not. They're selling because they want to sell. And it just happens to be the case that there was also institutional demand. But if the institutions are only prepared to pay 6 or 7% less, then the demand couldn't have been that strong, could it? Do you know what I mean?
Yeah, I mean, I think
I'm splitting hairs.
I think you are splitting hairs there. Yeah. Okay, good. We've got a question comes in from Paddock Steve. He's asking about hVIVO, which does the Challenger vaccine trials down in London. It's got a new facility, and it typically allows the sort of like big vaccine manufacturers to test new medicines on people under very controlled conditions in sort of like in their own premises. Shares have done really well. I don't know what your latest thoughts on this business.
Very good. Yeah, I reviewed this very recently. Let me just get my trusty spreadsheet up. I haven't updated this for 2 weeks, so it might be out of date. Yeah, I know. I've got 3rd of June a contract win, but it has announced something more recently that I thought was very good. Have you got it on your system, Paul? With the recent
Yeah, I was
news?
just going to try and put the chart up. Actually, it just came up on
Yeah.
another ticker.
Oh,
but,
here we are. 17th of July.
Yeah.
Yeah, I remember writing about this and thinking how good it looked. We've liked this one for a long time again, and quite a few of the Stockopedia readers like hVIVO.
It used to be open orphan, didn't it? It used to be open orphan.
It's the whole business has really been built in about 2 or 3 years. It's quite extraordinary looking at the how it went from kind of basket case to suddenly this fantastic growth, profitable business. It's quite remarkable. So I think a lot of people were very skeptical going back a few years. I know I was 2-3 years ago, but you can't argue with the numbers. So yeah, here we are. H1 revenue was up 31%. Oh, it's coming back to me. They said they pulled some orders forward in H1 that were completed early. So they're saying don't expect H2 to be quite as strong as H1, but that overall, calendar 2024, they're confident it'll be in line, and they've got full visibility for the rest of this year. Great. I think the order book was flat, so it didn't go up, and they got a £37 million cash in the bank because they get quite big dollops of cash as deposits from customers, which are non-refundable. I mean, yeah, I think it looks very, very good. 191 million market cap, hVIVO. Yeah, I like it. I think it's very good.
The follow-up question from Paddock Steve was about the one. I think it was the founder, Cathal Free. I think his name. He's basically sold a whole lot of shares or something in the business just recently.
So. Yeah, I saw the readers were discussing that, but I didn't comment on it myself. So yeah, you could. I mean, people can make their own mind up about that, can't they? I mean, the thing is, you know, with hVIVO, as long as it doesn't sort of fall out of bed and start going backwards, which I'd be surprised if it did, then you're only paying 18.8 times forecast earnings, which is not excessive, is it? I think
no.
It looks like the growth rate, I think, is probably slowing now.
I wish I'd got in. I mean, I picked it up ages ago, and it was that classic sort of thing. I'll buy it on a pullback, and it never came back.
Oh, I know. It's so frustrating.
And then, rather than paying up for quality, I sort of got stuck into value traps because value traps they just love me.
Oh, I'm absolutely useless at managing money. I just like doing the analysis. That's the bit I enjoy.
Anyway, the potential other companies is H&T. Now, this is basically the UK's biggest pawnbroker. It also does sort of like jewelry sales in its shops as well, and that can be new and used and stuff like that, and foreign exchange. But it's really dirt cheap. It trades at roughly 5 times PE, and the thing is it a value play or is it a value trap here? A bit like Serica Energy as much. I think. What's your latest on H&T?
Well, I mean, a little bit like Norcros. This one, I just scratch my head every time I look at it and say it looks the wrong price. I don't understand it. I mean, I haven't got a PE as low as 5. I've got forward PE of 6.5.
Okay.
Excuse me.
Yes, you're right. 6. I was looking at the wrong one. 6.7. 6.
Yeah, that's right. And the forecasts have been drifting. Oh, sorry, I keep hiccuping. The forecasts have been dropping a fair bit, actually. Well, I say fair bit. 68p a year ago, down to 56p now. So yeah, I'd need to look at. I wasn't aware the forecasts had dropped that much. So yeah, but I mean the balance sheet's just fantastic there. You're only paying 1.14 times tangible book.
Yeah.
I mean,
Graham likes it as well. He's gone through the balance sheet with a fine tooth comb, isn't it?
Yeah, we both really like it. We don't really understand why it's this cheap. You've got all that asset backing, but market just doesn't seem interested. So what can you do? But this is another one where you are getting a 5% yield. So any view on it yourself, Paul?
There's some smart investors in it. People like Judith McKenzie at Downing, and they love it. So yeah, I mean, I think if you're a value investor, I don't think you can go too far wrong with it to a certain extent. But it isn't the kind of stock that I typically go to. But
no, me neither, to be fair. And there was it Albemarle Bond was a listed pawnbroker years ago, wasn't it? I think, didn't they go bust, or they
Yeah,
bought
did
out?
yeah, which meant that it's now just really H&T and Ramsden's who are in the UK,
Yeah,
so they've got the market together.
yeah, and the thing is, with H&T, you've just got this bulletproof balance sheet, that you don't have any solvency worries with it, in my view. So yeah,
No,
I
I'd
think
agree.
a nice long-term hold. Hopefully,
Yeah.
there's not something lurking there that we're not aware of. You just never know, do you?
Okay. Well, I remember actually, we'll come into another share. It basically does, it's System One, which does sort of advertising services. It helps one of the,
Yes.
say, I don't know, a Cadbury's or a Unilever to test before they launch it, their new advertising campaigns and ideas to sort of like how emotionally attractive is it going to be, and to change the behavior of the person who's receiving the message to actually go and buy it. And so it's a unique sort of USP. And I remember reading one of your small cap value reports, and I think it's Boone who basically came up with it and said he'd been invested. So, and it's another rocket ship. I don't know your latest thoughts on this one.
Yeah, I really like it, and I should disclose, as with Intercede and with System One, I hold personally. I followed this share for years. It was a funny little advertising agency. Was it Brain Juicer? It used to be called.
Oh, okay.
Brain Juicer, was that another one? I can't remember exactly. I'm not sure. But anyway, marketing effectiveness it measures, and it set up this sort of blue sky thing where it reckoned it could, measure the effectiveness of adverts and whatever, and it's suddenly taken off. You can see from the charts that really the bull run in this started in December 2023.
Yeah.
I think you're right. So the readers flagged it to me or Graham to say, look, have a look at this, boys. And we did turn bullish on it in January, I think, when it was about I can't remember, about £3, I think. So we've caught most of the move upwards. But sod's law being what it is, again, I didn't buy any personally because I forgot about it, because we're constantly flitting from one thing to the next, you see, in the reports. Anyway, it's just carried on putting out great updates throughout this year to date. And finally, I think it was around a month ago, finally I bought some personally, so I had to pay up. You couldn't get them. It's so illiquid. You can only get scraps of 1,000 or 2,000 shares. So you have to buy in dribs and drabs. But I mean, I haven't got that many of them, but I paid about £6.70 or £6.80 for them. But I think the most recent update was 12th of July, and System One said exceptionally strong demand, somewhat ahead of expectations. Q1 revenues up 53%. So this is really exceptional growth, isn't it? And it said firmly on track for the full year, which sounds to me like there are more upgrades coming. So whatever they're doing, they're winning shed loads of new clients who, and that's again exactly the type of situation I really like. And they're selling in America as well, so huge markets, not just UK. And whenever you see, exceptionally strong demand, and those are the type of situations I like to jump at, even if it means paying over the odds. So we'll see.
Well, they must have some sort of magic in there, the US, to basically, because they're selling to the biggest advertisers in the world, and they wouldn't be taking it unless the service worked, and it gives them some, unique information. So yeah, I'm with you. Okay, let's move.
I think we don't have to necessarily fully understand the product, but if you see year-on-year revenues going up 53% and winning 70 or 80 new clients, I think they said, something good is happening, and that's good enough for me.
No, I know. Yeah, it's good. Okay, just turn into we've got Me Group, which basically does the self-service automated laundrettes and photo booths. It still trades at a very good sort of 13 times. Got cash on the balance sheet, and seems to have a good growth strategy in terms of bringing on new technology into its products, and which will reduce its costs as well. So, what's the sort of like your latest on this one?
Very positive. Yeah, we've been positive on this for a while. This was on my top 20 list of share ideas for the current year.
Oh, well done.
Yeah, no, it's done well. So, but most recently I covered it on 15th of July. And you always ask yourself, after a move like that, should you be banking profits, which obviously a lot of people will have been having that conversation inside their heads. And I mean, I've written about it several times when it's been at the new sort of rebased level of about £1.70, £1.80, and I've just said, look, for me, the numbers still work. This is not expensive, in my opinion. So yeah, I'm just scrolling down to, here we are, Me Group, £1.83. This was that was it. It was the H1 results that I reviewed on the 15th of July. Pleasing H1 results, confident inline outlook. I've said here, everything looks good to me. It's got a really good balance sheet, really good cash flows, because I go through all the detail when I write up results. I don't just, cut and paste from the thing. I actually drill into the bits that other people don't tend not to look at that much, like balance sheet and cash flow. It's self-funding its rollout of more of these laundry machines. I think it's stepping up the pace of expansion. They're very good. I've mystery cleaned with one of their laundrettes.
After a heavy night down the Mary Shelley, you've had to.
No, this is in London. It was. They're very good because they've got no overheads, because they put in petrol station forecourts, in car parks and things. So you have negligible rent and rates, and they're self-service. And these guys are total experts in any type of self-service machine. I think the intellectual property that must be within that, the heads of all the experience of the people at this company, must be a very valuable asset, actually. So anyway, they're doing the laundry rollouts at a record pace. They're now doing, I think you hinted at this, at next generation replacement photo booths are cheaper and better. And of course, because iPhone photos can be doctored, actually connecting to passport issuers and ID card government agencies through an installed photo booth is actually probably going to have a much bigger defensible moat around it than any of us realized a few years ago. So I think it's still attractive value. Yeah, I like it a lot. And the Stockopedia system as well, the stock ranks, rates it very highly too. So I think when me and Graham rate things green, and the Stockopedia computers do as well, our hit rate tends to be pretty good.
Yeah, well, you've done very well at it so far, and I'm with you. Actually, direct competition, there's going to be very little, because nobody else is going to be able to do what they do, and get that site and get the location, and it just isn't going to make any economic sense for somebody to compete against them. So I'm with you. It's just sort of like it should be a no-brainer. Okay, we got a question coming in from Dan Scott Lintott. He's asking about Anexo, which I think does it basically gives no claim drivers a car when they've been hit by another driver, and it runs it onto. And the shares have been absolutely a nightmare. I don't know if you've got any latest thoughts.
But I
think they've also got a couple of emissions, like they're trying to recover some money for people who have had basically the VW emissions and stuff like this. But you can tell from the shares it's been a bad one. But yeah, it's Dan Scott Lintott.
Yeah, well, Dan, I like part of your surname. Good name, but you're not going to like me. You're not going to like me one bit for this. I'm afraid it's one of my least favorite shares, Anexo.
Oh right.
Yeah, no, I'm red on it. Warning. The problem with it is it keeps reporting massive profits. This is almost a rerun of Accident Exchange. I don't know if you remember that one years ago.
Yeah.
They provide credit hire cars. They book enormous profits, but they can't get the insurers to pay. So basically, all these profits do not turn into cash, and you've got an absolutely unfeasible amount of receivables on the balance sheet. This is from 1st of May. I looked at Anexo's figures, end of 2023 calendar figures. Receivables on the balance sheet is 234 million.
What's the turnover?
I mean, 149.
Okay, yeah. So it's about 2 years.
18 months. Yeah.
2 years debtor days.
And of course, they've got to pay all the blooming corporation tax on these huge booked profits. The fantasy. The profits are not real, in my opinion. This is exactly what happened with Accident Exchange, and eventually they collapse because they run out of cash. And if you look at Anexo's balance sheet and read all the notes to the accounts, you'll find they're borrowing from anyone who'll lend them money, basically. They've got little scraps of loans and borrowings. I think it's. I've said here the accounts are just absurd, and it's got gross borrowings of 62 million, fiendishly expensive. They're paying a lot for the money they're borrowing to fund a debtor book that they're not showing any capability of actually collecting in. So no, I would say barge pole for this one.
Just to remind everybody, we're coming to the end. We've got just one more to go through. But if everyone wants to put a question into Paul, please put them into the chat box and read them out. We've got one coming from Paddock Steve. He's asking about any other thoughts on, any thoughts on Raspberry Pi, which I think it was basically a successful IPO just recently. But I think the shares have dropped a bit on the sort of like, the tech sell-off, particularly from last night, just recently.
It hasn't dropped a lot, has it? I did actually... funnily enough, I did publish on the 17th of June a full review of the IPO document. So have a look at 17th of June small cap value report on Stockopedia. That was when it was £4.20. I think it went to quite a big premium, didn't it? Can you remember what it listed at, Paul?
I think it was about, was it £2.50? Was it rings a bell?
That's what I had in my head. Yeah. So it was great that we got a decent size IPO that went to plan and went to a premium and has held that premium, a lot of it already. I do have quite significant reservations about it. Mainly it's a heavy dependence on Sony and on Broadcom for components and for manufacturing. The cash flow is terrible. If you look at the accounts, doesn't generate any cash. I'm skeptical about Raspberry Pi, but it is a great product, I'm told. And I'm told apparently it's got a fan base who kind of market the product for the company. So lots of interesting things about it, but I'm not sure it's a share I would want to own at anything like this value.
Okay, good. Well, let's move to the final one. We've got specialist packaging distributor Macfarlane in the UK, which I think does the packaging not for Amazon deliveries. It's more for sort of like high value, delicate items across numerous different industries. Trades at roughly around about what I've got. Am I looking at it right here? About 10 times PE. So relatively cheap. Got a decent balance sheet as well. I don't know if you give us you give us an investments thesis on this one.
This more or less goes on my top 20 list every year.
Okay, yeah.
Just a nice,
you love it.
Nice company, nice value. It's easy to look at it. I talked to a renowned fund manager about this actually over lunch, and he said, "Yeah, the shares never go anywhere; it just goes sideways." But actually, if you zoom out, over about the last 12 years, it's been a 10-bagger.
Oh, okay, right.
So it's quite interesting.
I see what you mean. It has, hasn't it?
Yeah, it has. So it's a multi-bagger sort of hiding in plain sight just because it's felt lackluster and gone sideways for the last few years. This is another one where they're doing lots of, I don't know whether you call it buy and build type small acquisitions. They just infill, if you like, geographically, and, they can apply their systems and IT. And, it seems to be good at making modest acquisitions that bolt on. I think I'm right in saying it's had a little bit of a wobble this year on trading. Didn't it put out a cautious outlook in the spring or something?
Yeah, I think it was basically they just acknowledged that it was tough trading in the whole area.
Yeah,
which is not a surprise because it's high value items, isn't it?
I don't even know what particular products it does, to be honest, Paul.
It's probably things like, I don't know, but if it's high value and delicate, it's probably things like medical items or paintings or antiques. I don't know, something like that.
Yeah,
your Porsche.
I know, I'm not driving a Porsche anymore. Not after 2022 being a bad year. But anyway, what we're going to say, I just think it's a decent business, Macfarlane. Good strategy, self-funding, lots of bolt-on acquisitions that it seems to do a good job at integrating and all the rest of it. I mean, again, it's not going to set the world on fire in your portfolio, is it? But what's the dividend yield on it, Paul? Have you got that to hand?
Yeah, it's it's about, what is it? Nearly 3%.
Yeah, 3%. Yeah, I've got 3.1% forward dividend yield, which is all right, isn't it? And
it is, no, it is good. Yeah,
I think it's a nice, fairly safe stock. The sort of thing I'd probably, in 10 years' time, I'd probably have in my SIP. Just ticking along. And
no, you wouldn't. No, you won't change the way you invest. No chance.
Yeah, you're probably right.
Don't give me that baloney.
But this is another one, actually, I think, where you've got a re-rating opportunity, haven't you? You know, it could just go from P of 10 to P of 13, and stay there once we're in a more bullish market. And mind you, packaging shares generally are cheap, aren't they? The bigger guys, I know they've got different business models, but they don't seem to attract. What was the one that got a bid approach from America?
There was Mondi got Mondi,
yeah.
and then there was another one, wasn't there, which also got taken. I can't remember what it was.
Two similar size, weren't they? That were always looked on high single-digit PEs. So this sector doesn't seem to excite the market, does it? I think Macfarlane's more a distributor, isn't it? It's got a small.
It is, it's more of a DS. Division, it's DS Smith, which is Paddock Steve mentioning. He is correct, DS Smith.
Yeah,
okay, brilliant. Just finishing off with them, Paul. Anything you've been selling recently at all? Anything you've sort of decided to trim to create? I'm guessing you've probably still haven't got much cash on the balance sheet. You've sort of like
no, fully invested, always fully invested. I mean, I've gone in and out of lots of things this year where I've just bought on impulse on a particularly nano caps. I went through a phase of just buying loads of nano caps. You know, when they put out good updates, you know, hoping for another Plexus, you know, to get a 10 bag or something, but it just didn't happen. Some of them I did all right on, but trouble is I've got bored with them within a month, and then when a new thing comes up and I think, oh, I should buy some of them, I have to get rid of these nano caps, and you can't sell the damn things.
Yeah, I know.
So I've not managed my portfolio well at all this year. So what have I sold? Well, I did buy some Card Factory last week on the Tele IOS clearance.
Well done.
But it ran out of, I bought them at 106, and then it seemed to run out of steam at 113. So I just chopped those out, made a bob or two. I mean, I don't normally do trading, but if you see an opportunity, why not? What else have I sold? Trying to think. I can't really remember, Paul. I mean, none of my convictions. I haven't sold any of my conviction stuff, you know, which is basically 5 or 6 shares. It's Plexus, Zotefoams, Intercede. What are the others? I can't remember. I've gone blank. Yeah. Sorry, Paul.
That's all right.
Well, we have been going nearly 2 hours.
No, I know. Yeah, no, we've done pretty well. I've got a big thanks, actually. My daughter's boyfriend has started listening to your weekly podcast on Saturday, which I've been listening to since they started. They're absolutely fabulous, and I'd recommend anybody else to. So he says a big thanks. And then just a month ago, my father, who's a retired and very keen stock picker, started to listen to them as well, and he loves it. So big pat on the back there, Stephen. Paul, because they're really good. You know, absolutely.
Thank you. Well, they're free and they got no adverts in. I just do them because I enjoy doing them, and it's a nice way to take stock at the end of each week and interact with all the subscribers, and hopefully we can convert a few people into Stockopedia subscribers. That's the idea. So you know. But it's just nice putting content out there, isn't it? I mean, we're addicted to this stuff, aren't we? Let's face it.
Yeah, I know. Well, I mean, it's high quality stuff. And one thing, if he could ever do, if you could split the sections into days, you know, like it's an hour, and you split them into days, then and just put the ticker for each day. You know, just go through, because I know I've had certain people saying, Can you ever give Paul a nudge to basically, you know, put the tickers on? But I know you talk about a lot of tickers, don't you, each day? Just the main ones.
The trouble, yeah. I mean, in the written reports, the tickers are all there in the title.
Yeah.
But in the podcast, I always say the company name and the ticker. And then what I do, and this is a good hint, I think, for all podcasters, is I say the company name 3 times. So I say it at the start. Then midway through, instead of saying they or the company or them, which a lot of podcasters do, you know, you end up listening to 10 minutes of something. You haven't got a clue what company they're talking about. Because when you're in the supermarket, you're pottering around Asda, you know, looking for your star deals. You know, it's easy to miss, isn't it, the company name? So I always say the company name 3 times, at the start, the middle, and the end. So if I remember.
What I meant would be if you have if there's somebody who's interested in a stock company A on Tuesday,
oh, I'm with you. Yeah,
they'll be able to go to Tuesday and listen to Tuesday,
yeah.
and then another one they might listen to is on the Friday or a Monday, and then rather than having to, I mean, I listen to the whole lot because I love it. But I can understand certain people.
You are right. It's admin, Paul. It's admin. I mean, I'm basically doing them as a one-man band, and
no, I know you're doing a great job.
You are right though. It would be better if it gave a list of which company at what time. I'll give
only in the days.
I think there is an AI tool on the thing I use that might be able to generate that automatically. So
yeah,
I'll make a note of that and see if I can.
If you just put the timestamps for the days, not the tickers, and then or if you could put the tickers on which days, but just on the days would be good because people know which days they reported on and what you then go through. You know, I guess.
Yeah, that would be quite simple and easy to do. Yeah,
because it'd be crazy. It'd be crazy putting timestamps for each company because you just do so many. But if you did them on the days, you'd only have to put 5 in.
That's a really good idea. I'll see if I can do that. I've just made a note of that on my pad.
Anyway, the main thing is that I know people are loving it and I'm loving it. And my dad, as I say, it makes his weekend. And my daughter's boyfriend, who's an avid stock picker as well, loves it. So
as long as I don't swear too much, it's not too bad.
I know, yeah. We've got a bit of feedback just trying to close it. Edward Hardy says, many thanks, Paul. Excellent material as always. So
thank you. Well done for lasting this long. You deserve a medal.
All right then. Well, thanks very much, Paul. I don't know whether you're heading down the Mary Shelley tonight, but order me a cod and chips, mate. I know, of course, you're going to Guernsey, aren't you?
Yeah. Well, it's been great fun, Paul. I've really enjoyed it. Thank you.
Thanks a lot. Cheers then, Paul. All the best.
Cheers now. Bye.
Bye.